Assalamualaikum warahmatullahi wabarakatuh. To our lecture, my name is Zuraida. Today, we would like to present our group assignment project 1.
Hi, my name is Zaid Sofia Fiti Hadina Suha.
My name is Nur Hazika bin Samsu Anwar.
My name is Nur Fatihah binti Zaba.
And my name is Nur Asmira binti Muhammad Fuzi.
Okay everybody, let's get started and keep on watching!
Question 1A. The appropriate accounting method for Mercury to record the investment in Venus and Mars is the consolidated method. Consolidated method is a method of accounting for investment where investor has majority control over investing. It is a type of investment accounting used for consolidating the financial statements of majority ownership investment. This method can only be used when the investor possesses effective control of the investee or the subsidiary. Mercury has 60% control over Venus and 70% over Mars. Therefore, the consolidation method works by reporting the subsidiaries' balances in a combined statement along with the parent company balances, hence consolidated.
Question 1B. The total amount of goodwill and bargain purchase of acquisition Mars and Venus as stated in the slide. For Venus Berhad, we got a goodwill amounted 456,000 after we compare total of CT and NCI with fair value of net asset, then we minus with impairment of goodwill 5%. But for Mars Berhad, we got bargain purchase amounted to 665,000 after we compare the total CT and NCI with fair value of net asset.
For question 1C, the total NCI is 6,355,000. The NCI amount, as I have circled in the slide, is contributed by the NCI portion of OSC of Venus and Mars, RPS, and retained profit of Venus and Mars. Next, the group retained profit is amounting 20,556,000. The amount is contributed from the retained profit portion from Venus, Mars, and Mercury. For question 1D, for CSOPL, all transactions that involve with Mars Berhad will be times with 6/12 since Mercury acquired Mars on 1st July 2017. For turnover, we will minus with 30 million and 15 million from inventory sold. For cost of sales, we will deduct with 30 million and 15 million from inventory sold and plus with 200,000 from URP. As for finance cost, we will deduct with 100,000 as it is an intercompany transaction. The amount of gain on sale of equipment and preference of dividend receivable is nil as it is intercompany balances. For interest income, we will deduct with 100,000. Next, the item that we'll have in CSOPL is impairment of goodwill, bargain purchase, depreciation plan, impairment of brand, and amortization in customer list. So, the amount of PAT is 1,951,000. Under comprehensive income, we will have ARR in plan. Of PAT attributable to parent is 8,801,000. While the amount of NCI is 2,150,000. The amount of NCI is calculated in working one.
Question 1E. The slide that we show is about consolidated statement of changes in equity. The total amount of RP is 18,251,000. The balance of BD that I highlight we got from working 2. Next, total NCI is 6,490,000 and total for GGR is 60,000. And the last one, total GARR is 720,000. Question 1F. The adjustment for PPE is we minus which impairment loss of brand, sales of equipment and UPOT. Then we will add with URP of sale and ARR. All the amount of investment in subsidiary and intercompany transaction is nil. For inventories, we will deduct 200,000 to eliminate the URP of inventory. Then, we will deduct 1 million in account of receivable for 400,000 in the bank because it is an intercompany transaction. Next, we will have cash in transit amounting to 200,000 and under equity and liabilities, the amount of preference share, debenture, loan from Mercury and debenture interest payable is nil. The amount of GRP, share premium, GARR, GGR and NCI are all stated in the schedule and statement of changes in equity. For account payable, we will deduct 1 million from additional information number 5. For OSC and PSC dividend payable, we will only add with the NCI portion of subsidiary. Lastly, for bill payable, we will deduct with undiscounted amount of bill payable. Next, the item that we added under equity and liability is bank loan.
Question 2A. State the area covered by the contractual arrangement as specified under MFRS 11 joint arrangement. Answer. Some of the areas covered by the contractual arrangement are as follows. First, the activity duration and reporting obligation of the joint arrangement. Second, the appointment of the board of directors or equivalent governing body and voting rights of the ventures. Third, the decision-making process matters requiring decision by the parties and the required level of support for those matters. Fourth, capital or other contribution by the parties and the manners of showing among the parties of the joint arrangement asset, liabilities, revenue, expenses, profit or loss. Question 2B. Describe joint control according to MFRS 11 joint arrangement and provide one scenario as an example of a joint control. The answer: joint control exists where the parties contractually agree to share control and decision about the relevant activities of the joint arrangement that have the unanimous consent of the all parties sharing control. The parties have to assess the extent to which the parties should act together to direct the activities that significantly affect the returns of the joint arrangement. No single parties control the arrangement on its own, but a party to joint control can prevent to the other parties from controlling the arrangement. There could be parties that have do not joint control. For example, 4 parties have an interest in a joint arrangement. 3 of the 4 parties have joint control and 1 does not. The party that participates in but has no joint control. The example of this scenario: A have 40% share, B have 30% share, and C have 30% share. Are parties to an arrangement. The contractual agreement between the 3 is that at least 80% voting rights are required to make decisions about the relevant activities of the arrangement. In this case, all these have joint control as all 3 have to agree the decision. Question 2C. Explain the accounting treatment for each type of joint arrangement specifically related to the right to the asset and obligation for the liabilities. The answer. The accounting treatment for joint operation under the rights of the asset is the parties' arrangement share all the interests. For an example, right, title or ownership in the asset relating to the arrangement in a specified proportion. For an example, in proportion to the parties' ownership interest in the arrangement or in proportion to the activities carried out through the arrangement that is directly attributed to them. But to the joint venture, the asset brought into the arrangement or subsequently acquired by the joint arrangement are in the arrangement asset that the parties have no interest, which is no right, title or ownership in the asset of the arrangement. The accounting treatment for a joint operation under obligation for the liabilities. The parties to the arrangement share all liabilities, obligation, costs and expenses in a specified proportion, which is in the proportion to the parties' ownership interest in the arrangement or in the proportion to the activity that carry out through arrangement that is directly attributed to them. But to the joint venture, the joint arrangement is liable for the debts and obligation to the arrangement. The parties are liable to the arrangement to the extent of their respective investment or their obligation to contribute any unpaid or additional capital or both. Creditor of the management do not have rights of resources against any party for debt and obligation of the arrangement.
Question 3A. The answer is the relationship between Lily Berhad before the right issue is considered a subsidiary and parent since Lily Berhad hold 75% ordinary share capital, but after the right issue, Lily Berhad and Barry Berhad still remain as a subsidiary and parent because Lily Berhad does not subscribe for the right issue and sold the right issue to the other parties. However, the number of shares issued by Barry Berhad increased by 320,000 units. Thus, Lily hold 54% ordinary share capital in Barry Berhad. 3B. The amount of goodwill on acquisition is 600,000. By comparing 2.2 million, then get consideration transfer OSC 1.8 million plus NCI 400,000 with fair value of total net asset on date of acquisition is 1.6 million. 3C. The amount gain or loss arising from not retaining the same percentage of interest in Barry Berhad is 544,400, which is loss on disposal taken to equity. Move to the calculation part. First, immediate prior to the right issue, 3,750,000 minus immediate after the right issue, 3,045,600, then get decreased in the share of the net asset amounted 704,400 plus proceed from sale of the right 160,000 arrive to the total of the loss on disposal taken to equity 544,400. 3D. The answer. The investee is no longer subsidiary since they only hold 48%, yet from 600,000 divided 1,250,000 made private placement. Therefore, it should not be consolidated in the financial statement, but the investment in associate should be shown in the financial statement.
Question 4. Explain briefly the relationship between Aisyah Berhad and Adam Berhad with reference to MFRS 10 Consolidated Financial Statement. The answer. On 1st October 2017, the relationship between Aisyah Berhad and Adam Berhad is associate. This is because Aisyah Berhad only acquired 40% of Adam Berhad ordinary share. If the debentures are converted into ordinary share, Aisyah Berhad will increase the interest in Adam Berhad by 25% and it will lead to the total of interest of 65%. Therefore, the relationship between Aisyah Berhad and Adam Berhad is holding and subsidiary, but no of debentures have been converted into ordinary share by 31st December 2017. Therefore, the relationship between Aisyah Berhad still remain associate because there is no increasing in shareholding.
That's all from us. We hope that Madam enjoyed with our presentation.